There's a lot of speculation lately about whether the U.S. is officially in a recession. If you are confused about whether the U.S. economy is in a recession, you are not alone. On one hand, gross domestic product, a key measure of economic output, has shrank for the second straight quarter, raising fears that the country has entered or will soon enter a recession territory. On the other hand, the job market remains very strong, telling us the economy is still robust. Some economists call 2 consecutive quarters of contraction a technical recession. And with good reason. 10 of the last 10 times the U.S. economy shrank for 2 consecutive quarters, the U.S. economy was declared to be in a recession. But massive job losses occurred during 7 out of the past 7 recessions. And that's not happening now. Both President Joe Biden and Federal Reserve Chair Jerome Powell said we are not there just yet, pointing to the strong labor market and rising wages. The official declaration typically comes from the National Bureau of Economic Research, and it has yet to call it. But regardless of the country's economic standing, consumers are struggling in the face of sky-high prices, and nearly half of Americans say they are falling deeper in debt. ARK Invest CEO Cathie Wood believes we are already in a recession. In a new interview, she shares her views on the current market situations. She shares many insightful ideas that you don't want to miss. But before we listen to Cathie Wood, we want to use this opportunity to thank all our viewers and subscribers for all your support. Thanks for watching our videos.
Cathie, the key debate on Wall Street, what everyone is discussing is the Fed going to continue hiking rates, or are they going to stop and turn around to come back down next year? What do you think?
We think the latter. We're getting all kinds of signals that the economy is very weak. I know a lot of people are focusing on last week's big employment gain in non-farm payrolls. But if you look at household employment, which is a much broader based survey of employment, that has been flat to down for the last 4 months. If you look at claims, we've never seen a faster increase off the bottom than we've just seen. We're up about roughly 50% from the lows. Many people, I don't think, have taken a close look at that. And we're hearing one layoff after another. And we know the Challenger survey says that layoffs are up 55 to 60% year over year. And I think this is all related to inventories. We have a massive inventory glut. And so I think that the last few hires, I think companies were really happy to get them because labor was in short supply for so long. But I think that
now there's an inventory
going to see the unwinding.
Yeah, Cathie, it reminds me, the last time I saw you on Bloomberg TV, you were talking with Ed Ludlow out of Bentonville, Arkansas, and you said to him, we have a real inventory problem. Walmart and Target had just been out with numbers that were concerning in terms of the buildup of product, and you said deflation is more of a concern than inflation. Do you still think that after the big prints that we've seen, and we're still expecting, for example, 8.7% headline CPI on Wednesday?
Yes, I still think that because the evidence is piling up. Now, the CPI and in some measure, the PPI, both of those are lagging indicators. The Fed is driving policy off of lagging indicators. If I look at Dr. Copper, the commodity with the PhD, it had been trading for a year in the $4 to $5 per pound range. It's now down to $3.50. It's had a decisive break. And if you look at how that's going to feed into the indexes, it'll feed in slowly, to be sure. But just month over month, copper is down roughly 20%. And year over year, it's down roughly 20%. Mm-hmm. So that's the activity side of things. If you look at the real inflation gauge out there, it's gold. Gold prices peaked in August of 2020, 2 years ago. And we've been in a trading range, to be sure. We're at the low end of that trading range now.
Right.
If the Fed continues to tighten, we believe the dollar will turn back up and these commodities will continue to fall.
So, Cathie, if we have disinflation coming and in your view, the economy in a very weak spot, big debate right now is whether we're currently in a recession. Obviously, it's up to the NBER to officially declare that, but curious to hear your take on where we are currently.
Yes, well, we believe we're in a recession. 2 consecutive quarters of real GDP declines is the beginning of that definition. 3 consecutive months of declines in leading indicators, which we have now, would suggest the same. Now, I think the differences are we see an inverted yield curve, and that, of course, is also a warning sign. I think our point of view is that this is going to be a severe inventory recession, but we didn't have the systemic excesses like we did pre 08-09 in the mortgage market. So it's an inventory recession here. And while most economists are saying, oh, okay, the inverted yield curve points to a recession maybe next year, we believe we'll be coming out of it next year. Now, I think the big question is what's going on in China. I think some of the commodity price decline has to do with China unraveling in some sense from a cyclical point of view. I mean, they've got their foot on the brake in many ways. They're trying to let it off a little bit here and there. But I think that the real estate downturn in China is 30% of their economy, 75% of consumer savings. I think they're not going to be able to control it the way they thought they were.
Kathy, it's Eric here. I asked Twitter for some questions. I got a good one, and I agree. This is a good question. A lot of people have it. If you believe we're in a recession and you believe the Fed is going to go on a sort of hike-raising path, why not go to cash? Why stick into the fund? It's an actively managed ETF. You can do whatever you want, and I guess some people wonder why not have more of a cash reserve.
We are going to be 100% invested in innovation. That's who we are. This is what we're paid to do. This is what we say we are. And we think that innovation is going to be a critical allocation in the years ahead as the world moves rapidly. And it tends to innovation tends to gain traction during tough times. Innovation solves problems. We have so many problems right now. We've got the supply chain problems, which we're still hearing about. We've got energy and food prices up because of the war, really hurting consumer purchasing power. And so I think better, cheaper, faster, more productive, more efficient, more creative is going to win. That's what innovation is. So we think most asset allocators are short innovation. And I don't mean NASDAQ 100. We don't think that's truly disruptive innovation. We believe that our ARK is more the old style NASDAQ than the NASDAQ is today, because that's all we focus on. If our outlook for deflation is correct, cyclical deflation and secular deflation, deflation associated with technologically enabled innovations. That's a good deflation. That's not a bad deflation. If those two are correct, that would be the best environment, I think.
According to Cathie Wood, she thinks we are going to have an economic deflation. Deflation is when consumer and asset prices decrease over time and purchasing power increases. Essentially, you could buy more goods or services tomorrow with the same amount of money you have today. This is the opposite of inflation, which is the gradual increase in prices across the economy. When prices go down, it's generally considered a good thing, at least when it comes to your favorite shopping destinations. When prices go down across the entire economy, however, it's called deflation, and that's a whole other ballgame. Deflation is bad news for your country and your money. While deflation may seem like a good thing, it can signal an impending recession and hard economic times. When people feel prices are headed down, they delay purchases in the hopes that they can buy things for less at a later date. But lower spending leads to less income for producers, which can lead to unemployment and higher interest rates. This negative feedback loop generates higher unemployment, even lower prices, and even less spending. In short, deflation leads to more deflation. Throughout most of U.S. history, periods of deflation usually go hand in hand with severe economic downturns. What do you think of Cathie Wood interview? Do you believe we are already in a recession? Please let us know in the comment section. Until our next video, please stay savvy.